on average, the rent was going about $850 a unit. As soon as we took over the property, we bumped it up to $1,000, and now the renovated units are renting for $1,350. So it's a nearly 55% increase, and the income growth supports it. You look at all these metrics; it's a no-brainer to invest in Florida.
This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odom and Steven Silverman.
Hello and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odom, along with Steven Silverman, in the depths of winter. Actually, it's not even winter yet, is it?
No, but we had to put on a sweater for the first time today. And
it's just unbelievable. It's, our building, we're on the top floor of a mid-rise building in Tampa, and air conditioning doesn't work so well. I look forward to the winter when we don't have that issue. We actually had a cold front move through. And what do? They put the heat on. It's like it's 62 degrees outside and you have the heat on. I want to stick needles in my eyes. I mean, it's just unbelievable.
Yeah, it's true. But, I see we're at 62 in Florida and we're freezing. But when I look at other parts of the country, I'm glad we're in Florida.
Yeah. I mean, it's the first really big cold front that's moved through, powerful one that's pretty much the whole country is being affected by it. So, I look forward to it. I'm ready to go back outside, but because it's a sauna in our office.
Yeah, we'll talk about change. So we're talking about a change in the weather, but there's been a change in investment and the way real estate's working. That's very difficult to find supply. There's a lot of demand and people complain a lot. But in our conversations, we found someone who hasn't been put off by that and has managed to find a way to be successful and continue investing. And that's what today's podcast is about.
Yeah. And we've got rising interest rate environment. Actually, it's tapering off. It seems to be, the projections are that it's going to be headed back the opposite direction. But, it's been a tough year this year for sales. Most sales are down significantly on the commercial side, on the multifamily side, significant drops. So anyway, it's good to see folks out there still working and hustling and try to make deals happen. It really is, folks will pull their horns in and say, there's nothing to be done. There's always a deal. You just maybe have to work a little harder to find it, right?
Yeah, absolutely. Let's roll into it and talk to Jim because he's done a remarkable job.
Great. Let's get with Jim.
Today we have with us Jim Lee. Jim is a real estate investor and founder of Formosa Investing. Jim received his Bachelor of Science degree in economics in 2010 from UCLA and started his career as an inside sales rep for LoopNet and CoStar. By winning a $50,000 sales incentive bonus, he used that savings to purchase his first 2-bedroom, 1-bath condo and learned the importance of having multiple streams of income. Now, through real estate syndication, he has invested in over 600 units in the past 2 years, where he has participated as a general partner and a limited partner. Jim, welcome to the Invest Florida Show.
Thanks for having me, guys.
Hey, Jim, we really appreciate you investing time with us today. We thought it was an interesting story to kind of hear a little bit about your background, because obviously coming from LoopNet, CoStar, that arena gives you a unique perspective because you have access to a lot of brokers. And then you broke out of that working for someone else, hourly wage type of a deal or salary deal, and started doing the syndications. And that's kind of hard to do. But I think even more importantly, you started out doing deals in Florida. So why don't you tell us a little bit about the path, like what you were thinking when you were at your job and how you arrived to where you are today?
Yeah, absolutely. So as you know, I graduated back in 2010. That's right after the 2008 subprime mortgage crash, followed by the 2010 European debt crisis. It actually took me a year to find a job in that market, tough recession. And I went through lots of interviews, got really good at selling myself, and eventually I was fortunate enough to land an inside sales role at LoopNet. And through LoopNet, I was able to speak to property manager, real estate agent, investors, lenders on a daily basis. And that's how I was able to start learning about real estate and having passive income. From there, I just never looked back, and I've always been passionate about real estate because I knew that from the get-go that working for somebody, it doesn't provide 100% stability. You can get fired at any time. So it's always good to have multiple streams of income.
The problem is that when you're working for yourself, the biggest boss can be your jerk.
Yeah.
You know, Eric can be your boss.
You'll find that Eric speaks a lot from experience. But Jim, there's something else. You attacked this with a vigor and an enthusiasm, and where is your family originally from? Because it's almost like an immigrant kind of mentality that you have in making things happen here.
Steve's from the South, so he knows about immigrants.
Yeah, good catch. So I'm originally from Taiwan. I was born and raised in Taiwan, Taipei. I immigrated here when I was 11 years old. Just like any other parents, my dad wanted to bring us here, give us an opportunity to thrive. And that's why I always tell myself whenever I want to give up to continue to persist because of that particular reason. I'm doing it for my family, to get us to live a better life, build wealth through real estate, generational wealth I'm talking about. So, and that's why I work so hard to continue to strive to get better.
That's the making it an American story, right? I mean, it's interesting to me. There are so many folks that will bemoan their situation and that they don't have chances. And, Stephen, it seems like, maybe a third to 25 to 30% of the folks that we have on our show are folks that we're immigrants and have stories of, not saying this is the case with your family, but we've had folks from Cuba and Brazil and Mexico. They literally came with nothing and have built very, very strong businesses. The American dream is still alive, as much as people want to poo-poo that the system's rigged. I don't know. Do you fit in that camp, Jim?
Yeah, absolutely. I actually relate to all those people. I have a lot of Brazilian friends, Cuban friends. I know they're heavily populated in Florida, and they have there's a lot of investors out there that likes to bring money over to invest in Florida. And so a couple of my investors actually invested in my syndication deal out in Florida. That they're from Brazil as well. So so I definitely relate a lot to them, and that's probably why I travel to those places, because it does give me a sense of humility when you go to a third world country and you find out how you should be grateful for all the things that we have here, even though on a day-to-day basis you hear people complain all the time, right?
Tell us how you got started on that first deal. I mean, there you were sitting at LoopNet CoStar, and you got an award for being a great sales rep. And then how did you launch from that into properties?
Yeah, another good question. So because I was jobless for a year after graduation, once I got into LoopNet, I didn't want to go back to that old days again. Like I was just basically more hungry than any other sales rep in the company. I worked 10 to 12 hours a day, took my work home on weekends just to study the materials and rehearse my speech and what I should say to my client. Took the job very, very serious. And when CoStar bought LoopNet, the CEO of CoStar threw this huge incentive, and I managed to win second place, and that's how I won that big prize. From there, I was able to build recognition because once CoStar bought the LoopNet, they started laying everybody off from LoopNet. So I moved to another W-2 job to another W-2. So I was in the W-2 space job for 7 years. Eventually, in 2015, one of the realtors I met through LoopNet, she was still in contact with me, and she reached out, say, "Hey, I got this pocket listing deal. Would you be interested in investing?" And I said, "Yeah." And that's how I started with my 2-bedroom, 1-bathroom condo here in California.
So your first deals on the syndication side were in Florida, right?
Yes.
Tell us about those deals. What kind of deals are they, where they were, and why you decided that these were deals that you needed to act on?
Yeah. So to kind of transition how I went from condo to multifamily is that I did everything pretty much from A to Z for the condo. I was very actively involved. I dealt with the tenant, toilet, and trash. And eventually I realized I wanted to be more passive. So I started to delegate tasks. I started to build the system. But it's hard to scale because a property manager is not going to pay much attention to one small little condo. They have hundreds and thousands of units to manage, right? And that's how I got interested in syndication, doing bigger deals. And to answer your question, the deals I have in Florida, the first deal I did was a 200-unit apartment building in Orlando, up north, El Monte Spring. And then the second deal is in Jacksonville, 400 units. And they're both Class C apartment building built in 1970s. So it has a value add component to it. And we plan to hold the properties for 5 years until we sell it.
So Stephen and I are brokers, and we've done some multifamily. It's not something we focus on. We did quite a bit of it when the market was coming out of its cocoon from 2008. So 2012, 13, 14, 15, something like that. We did a half dozen multifamily deals, and then occasionally I'll do one every year or 2 years, but it's really not something we focus on. I mean, it's hard. You have to be in the business really to be able to get the deals, and you have to be focused on that. And it's just an area that we're more into retail and industrial. I know this is a long preface, but to the question, but we probably have from our time when we were doing multifamily, 1,000 people that are looking for deals. And Stephen, I don't know about you, but I probably get a call once every week or once every 2 weeks of somebody looking for multifamily. And it's hard for outsiders. This is something we talk about all the time on the show. And, and you're from out in California, that's got to be hard. Because like for us, like we're going to take our deals, the few that we get, to the people we know that can execute. We know them. And so this is, you coming from California and your first deals you got done, and that's so unusual. So,
but remember, Eric, it was a different time then. He's not talking about 2023 where we are now, but coming out a little bit after the recession, there was still an appetite for sellers to try and find some buyers.
No. I mean, I understand this, but I'm talking about there were still buyers in that market too. We had people we took our deals to that we knew they could execute. So I'm curious, because this is an important point for so many of our listeners that struggle to find deals, and the broker's going to look at, well, I want to see your list of deals that you've consummated, and they're going to trust those folks that have transacted deals. So tell us a little bit about that process. Did you feel any apprehension from the agents or the people that were bringing deals to you that you're capable of executing? Because I mean, it's not normal for someone we see people coming from California coming to Florida, and that's their first deal they execute, and people trust them to do that, to engage. So maybe you could tell us a little about that, Jim.
Yeah, absolutely. So we found our deal through my business partner's network. He's known this guy for about 2 years. He's part of a group called Think Multifamily. He's done deals in Florida, Jacksonville before. He's had track record of being able to close. Okay. Yeah, of being able to close deals. Right. And so the agents would send them deals all the time, and he has back in 2020, he has more deals on the table than he has capital. So he wanted to do just a lot of deals due to, the relationship he has built with these agents throughout these years that he has been syndicating. He's been an investor since 2006. So you can imagine he's been in this industry for a long time. And he has proven track record to be able to close. So these agents love him because, at the end of the day, that's all they care about is the commission.
It's not all they care about. They don't get the commission if they can't consummate the deal. And this is one of the things that, again, with our listeners, we hear that frequently. They get very frustrated that, hey, I called this broker, he doesn't call me back. And guess what? I mean, they're looking at you online and seeing that you're a marketing manager for a firm in Memphis, Tennessee, and there's nothing about real estate on there, they don't want to spend an hour talking to you on the phone when they already have people in their back pocket they know can complete a deal. So, but you answered the question that there was the pump was already primed with your partner who had some consummation or had consummated some deals in the state, and so people knew who he was, and that's the answer.
So, Jim, tell us how you approached the deal. Did you first put the property under contract and then look for investors, or you had investors that were known to you and your partner? And also, did you close in cash or did you take out loans? What were the mechanics of the deal?
Yeah, absolutely. There's a lot of moving parts to it. So I'll break down everything as much as I can for you guys. So typically we go out, source the deal. Agents send the person the key principal. The key principal basically is the loan guarantor. They have to sign off the loan, have the net worth to be able to sign off the loan, and have all the necessary liquidity to be able to sign that off as well. And so we find a deal, then we put as amongst the general partners, we would have to cuff up the deposit to secure the property, to show the seller that we're serious about buying this property. Then we have 60 days to basically raise that down payment. And that down payment comes from just retail investors, any kinds of investors, right? So that's what syndication is about, just pooling all investors' money together to buy one property and then split the income. So after that, once we raise all the down payment, we close it. And from there, we just asset management. It's all about managing the property manager.
And what kind of yields do you promise your investors, and how have you found that?
Well, promise, you got to be careful that word.
Estimated promise, and how have you found that to change over the last few years?
Yeah, so what we project is very typical, just like any other syndicator out there for multifamily. It's an 8% preferred return. Anything above that, it's 70-30 split, 2x equity multiple once we hold the property for 5 years and sell it. If you guys want me to clear some things up, I can explain in detail what all that means.
Yeah, please, because let's talk a little bit about our listener base. We've got pretty broad base of listeners, and we've got folks that just do single family homes, and it probably makes up the bulk of who listens to our show. But there's also all the way down to large syndicators and developers that also listen to it. So we want to talk to everybody here, but many of the single family home folks that have not engaged in syndication, they might listen to a podcast once in a while on this. Let's make sure we'll just cover those points like a little bit more in depth of what exactly those things are, your waterfalls and all that sort of stuff.
Absolutely. So the 8% pref, what that means is just that let's just use an easy number as an example. If you invest $100,000, you'll get $8,000 of passive income, mailbox money that we call it, and every year. And 2x equity multiple, it just means that once we sell the property, if you put in $100,000, you'll get $200,000 back, 2x your money back. So you're looking at 28% annualized return year over year. However, there is a catch, and this is something that I'm pretty upfront with my investor about that people should be aware of. It sounds all good on paper, but there are scenarios where the first year you might not get distribution, that 8%. And the reason why that doesn't happen is because upon taking over ownership, changing ownership, typically there's turnover, right? And then you also have tenants, bad debt. You have to evict some bad tenants. So it does take about 6 months to a year to stabilize the building. If it's a Class A, Class B building, maybe it takes a lot less. Class A might just cash flow from day one, but since we target value add Class C, it takes anywhere between 6 months to a year to stabilize it. And once we stabilize it, that's when. And the reason why it takes that long is because occupancy would drive from 90 to 80%. And on top of that, we're using the first year's cash flow to renovate the apartment building. So that's why there's no payout. However, what preferred return means, the word preferred, is that if we don't pay you out, let's just say we pay you out 1% the first year. that 7% is still owed to you. That 7% does get accumulated to the next year. So 7 plus 8%, 15 will owe you at 15. And then until there's a liquidity event, let's say in year 2, year 3, we cash out refi, we add enough value that we're able to appraise the property for higher value now. Now we can pull some money out, return some capital back to the investors, or we sell at the year 5, and that's how you're going to get all your preferred return and your equity multiple.
Gotcha. And so why don't we go back a little bit to the genesis of the organization of your syndication? So your partner, why don't you tell us about him, like how you met him, and like why and how you decided to go ahead and start doing business with him and join forces with him?
Yeah, absolutely. So I have great mentors in my life. My first mentor was she helped me buy my first condo, got me into become a realtor. So I was a realtor for 2 years as well. I understand the hard work that you guys put in. So I did that for 2 years. It wasn't a good fit, and that's how my second mentor kind of introduced me to a podcast show called the Real Estate Radio Show, the Real Estate Guy Radio Show. And so on the show, they kept pitching about syndication. And so doing bigger deals, easier to scale. So as soon as we opened back up, I went out to Texas to network with these guys. And I was fascinated with syndication. I studied syndication from 2020 to 2021, and I realized I was missing a lot of pieces of puzzles. Right, I had one component where I can raise some capital for my list of investors, but that's it. I don't have track record experience like you mentioned earlier, Eric. So investors are not going to invest in my deal. So it's tough. So I knew that I needed to find someone that's a little bit ahead of me. Maybe someone who's had track record, syndicated apartments before, and so from 2021 to 2022, all I did was go to real estate conference, go network, and eventually through the Real Estate Guy radio show event called Investor Summit, I managed to meet my business partner. At the time, I told him I can raise some capital for him and I can add some value to his life. And he's basically my business partner. He has syndicated 5 apartments out here in California. And he's been doing it for 3 years. He has 5 kids. He does everything from A to Z by himself. He doesn't want anybody help, but he ran out of time, resources, and money. And so he went out to Investor Summit to find someone to help him out. And we just clicked the first time we met.
Yeah, that's awesome. And so your first deal was transacted when?
My first deal was transacted last July of last year.
And that was the one in Altamont, you said?
Yes.
In Altamont, okay. So tell us a little bit about that one. It came through his network, and what did you think when you did the deal? What were you thinking in terms of, hey, this is something that we can really hit the ball out of the park? Or what were, like, the underwriting aspect of it? What were your thoughts when you looked at it?
Yeah, what did you like about it?
I love the location. We're in pretty much Class A neighborhood. But the building itself is Class C. So I knew that it's only a matter of time for us to get in, improve the operation, the efficiency of it, because we actually bought this deal from another person that's also from California, but it's just poorly managed. A lot of tenants not paying, a lot of turnovers, hundreds of work orders backed up. These are the things that you can tell, like, as soon as you're able to look at all this and basically think about ways how you can add value, that's instant. Like, it's all just a property management issue, right? Because at the end of the day, your property management company can make or break your deal in syndication. And so, and we learned our lesson as well through this deal, is that we had this $1 billion asset under management property management company that we hired, and we had to fire them because they couldn't handle the bandwidth of hundreds of work orders. They didn't have presence in Florida, so we had to find someone property management company who specializes in that market and just that market, and that's very important. Either that or just vertically integrate it and just make your own property management company, and that's what I'm seeing a lot of syndicators are doing these days.
So, expand on that a little bit. You say vertically integrated. Tell us what you mean by that.
Vertical integrated basically is just creating your own property management company, so you don't use the third party. Because when you use a third party, it's really hard to manage and control the things that you want them to do. It's because they have other properties to manage as well, right? But if you have your own management company, you're in control of everything. And
with it, you get the overhead though, so it's it's to cross that line where you can. Yeah. Where it really starts to be worthwhile.
Now you have another scaling issue, right, on the property management side of, for the software, right, and the maintenance guy, the engineers that you need, and so I'm curious how you guys are handling that. I mean, is there a manager on site for each one of your properties, and how's your maintenance handled and that sort of thing?
Yeah. So yes, we have an on-site manager, and that's the scalability, right? I wouldn't be able to afford to hire an on-site manager just for my one condo here in California. But with 200 units, we have one on-site manager 24/7. Basically, they live at one of the unit rent-free. And then with the maintenance, we have a team of contractors, vendors. Our units, the 200 unit in Orlando, it's already 90% renovated within a year, because the lead sponsor of this deal, he brought his whole crew to this deal, and he started doing renovation. And so we're on top of everything. When we first bought this property, our net operating income was at $60,000, and it's grown up to $200,000 now.
Oh my gosh, that's good! Congratulations.
Yeah, thanks. And with only just a span of 1 year. So so that's everything is going really well with that property. But due to high debt and high insurance costs, as you guys may know,
insurance, oh my god,
yeah, it's killing us just right now. Even though our operation is doing really well.
So with leading into that, then in today's market, it's a little bit different. Interest rates are different. When you talk to investors, or if you're looking at other deals, would your proposition to investors change now? Because, it's one thing to do only a 6 cap or a 5 cap when the interest rates are like 3%, but when interest rates are close to 8%, it's a different kind of proposition.
Yeah, absolutely. You have to be very, very conservative with how you underwrite deals these days. I mean, there are still opportunities out there, but this year I haven't done any deal because of exactly the reason that you mentioned, Stephen. And so right now it's all about just trying to figure out ways of how can we increase more revenue and cut costs, right? We're just figuring out creative ways to add amenities such as, install a car washing station, pet washing station, or offer lockers, storage space to the tenants at extra additional costs, and also parking, You can have carports, you can have garage, you can have regular parking, but whatever, if you offer garage, then it's going to cost the tenant higher. So yeah, we're just trying to figure out creative ways to increase income at this moment.
Yeah, and that's what I was going to ask in terms of what amenities are you trying to add that are going to add value to that rent, to the renter. What are you looking at right now besides the car wash and the pet wash and this sort of thing? Is there any other things like inside the unit, putting a washer, dryer, that sort of thing? Is there anything inside the unit that you're changing?
Yeah. Washer and dryer, if there's already hookup, then definitely we try to do so, but we're not going to completely put a washer dryer in every unit, just whatever makes sense. For the time being, because we also have to learn to balance our reserves, right? We can't overshoot ourselves, especially with this high debt environment, and so we're just trying to survive to 2025 at this point and try to keep balance of the reserves.
Gotcha. So tell us about some operational things that you work, like software. What are you using that you like that's working for you guys?
I am not, I have to be upfront with you. I'm not too sure exactly what our property management company uses. And my role as a syndicator, I don't work much on the asset management part.
Understood.
Yeah. I just work on raising capital, investor relation, and marketing.
Gotcha. Okay, that makes sense.
So this year's been difficult, and you said that you still feel there are deals out there. Do you have any feel? First of all, what are you looking? I'm curious. You're from California and you're investing in Florida. What are your feelings about Florida and as compared to the California market where you live?
I love it. It's a lot better than California. I love every aspect of Florida. I can imagine myself going there and live there as well. But all my friends and family are here, so I'm pretty much homesick, you know. But Florida, if you're talking about real estate investing, I love it. First of all, you know, you guys already know it's landlord friendly compared to California. That's huge. During lockdown, you guys still went about doing your business friendly, you know. That's a plus, and that's something that you have to look at this aspect of is the economy going to be shut down, and is it going to still continue to grow, and basically just look at all the risks factor, right? When you sell a deal to an investor, you have to let them know all the risks. And so we're just trying to mitigate as much risk as possible by investing in Florida. And the population growth is definitely there. The job growth, income growth is definitely there. That's why, you know, when we bought this multifamily, on average, the rent was going about $850 a unit. As soon as we took over the property, we bumped it up to $1,000, and now the renovative units are renting for $1,350. So it's a nearly 55% increase, you know, and the income supports it, you know. Yeah, the income growth supports it because before I invested in Florida, I actually did a huge amount of research where, you know, during lockdown, I noticed that the migration pattern, a lot of New York companies are bringing their business down to Florida. And they're, you know, this is like tech companies, you know, high paying jobs. It's creating a lot of population growth and job growth. So the income supports it. So you look at all these metrics, it's a no brainer to invest in Florida.
Talk to us a little bit about the syndication. This is a Reg D private placement, correct? Mm-hmm. Okay, so so for listeners that don't know what a syndication is, we're required. There's the Howey 3-prong test. Basically, if you're making money for other people, you have to register with the Securities and Exchange Commission. And most of these deals are done as Reg D private placements. There's several different types of Reg D private placements. But even if you're doing it with friends and family, it doesn't matter. Is somebody expecting a return from your efforts as the asset manager or the deal syndicator? And if you are, well, it needs to be registered and documents filed and whatnot and appropriate documentation. So who are you using to put your documents together?
We have a legal advisor that, you know, Mauricio. I don't know if you ever heard of Raul. He's been doing some legal work for us. But to your point, with the securities law, when you, like you said, when you take other people's money and basically they just passively invest, you must comply with securities law. And basically you just have to find an exemption, right? There's something called 506B and 506C. 506B is basically you must have a pre-existing relationship with your investor before they can invest in your deal. And anybody can invest as long as you have that pre-existing relationship. 506C, which is what most syndicators use, is that you need to you can only take accredited investors. And accredited investors is people who have a net worth of $1 million or they've made $200,000 in the past 2 years. So those are the exemptions. So 506B, you can take non-accredited investors, and 506C, you can only take accredited investors.
So, and I'm sorry, who was the person that's doing? Because I wasn't familiar with him.
Mauricio Raul.
And where is he based out of?
He's also from Texas. He's part of the Real Estate Guy radio show. People.
Gotcha.
Yeah.
Gotcha. Okay. I'm trying to think of what else, Stephen. Is there any other questions you got for Jim before we let him go?
Well, I was just curious about the name you chose for your company, Formosa. Was there anything behind that?
California Spanish name.
Good guess. Formosa is a nickname for Taiwan. So back in 1500, the Portuguese discovered the island Taiwan before Taiwan was named Taiwan. And so they named it Formosa, which means the beautiful island. And so, yeah, that's basically my brand, my brand identity. I come from Taiwan, and that's why I named it Formosa.
Oh, I hadn't made that connection. That's
Yeah.
amazing.
I just, just looking at the name, it was just so interesting to me because you don't hear the name Formosa mentioned anymore, really. But you look at all the history books and it's there.
Yeah. Good catch.
Yeah, well, that's cool. So Jim, you came on the show today. We wanted to talk to you a little bit about Florida, a little bit about syndications and about what your programs are. I know that you want to find deals, you want to find investors, you want to network with people, and I'm sure there's some folks after listening today they're going to want to speak to you. So, how would people go about getting in touch with you?
Yeah, they can visit my website, formosainvesting.com, or they can connect me on any social media. I'm on LinkedIn, Instagram, Facebook, Twitter at Formosa Investing.
Awesome. Stephen?
Well, awesome. Thank you for being with us. And, good luck as we move into the new year and interest rates are coming down and hopefully you'll find those opportunities you're looking for.
Absolutely.
Yeah, absolutely. Thanks for having me on the show.
Yeah, thank you for your time, Jim.
Thank you.
And that was Jim Lee from Formosa Capital talking real estate syndications, mostly on multifamily. I think that's all he's done is with multifamily. He focuses on multifamily. Stephen, what were your thoughts after we spoke with Jim?
I love talking to Jim. We talk to a lot of people, and people, for some, the glass is half empty, the others a glass are half full. It's difficult times, and Jim, even with this lack of supply that we've been facing, he found a way to do a deal and add value, and it's great for him. And I'm sure the way he's doing it, he'll have continued success.
It's always interesting to me. People complaining about this situation in this country that you just can't, it's not the same. You can't make things work. And I don't know. I've traveled all over the place. I've lived in a lot of different places. This is the best state and the best country for doing business that I've been exposed to. And it might not be the best in the world. If there is, I don't know better because I only know what I know. And when you see folks that come from outside of the country and have success, it kind of makes those arguments from folks that are third generation here a little bit more hollow. The immigrants, folks that come here sort of make the world spin. And it's interesting to get a guy like Jim or a number of the other folks that we've had on the show, guests that are not originally from here that have been enormously successful. It just shows that the American dream's still alive, right, Stephen?
Absolutely. I just think you're right. It's a question of perspective, and immigrants will come in and see values that they'll recognize things that we just don't see because you can't see the woods from the trees.
Yeah, no question about it. Jim was a great guest, Stephen. Other great guests, where might our listeners find them?
Place to go is our website, www.investfloridashow.com. Also download the app so that you can listen when you're mobile or in the gym.
Guys, as always, we appreciate the time that you invest with us each and every episode. Until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odom and Stephen Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida show.